Hey everyone, welcome. As a text professor, I get asked about all sorts of things, but the one topic that comes up again and again, childcare expenses. It's a massive deal for working families, but let's be real, the rules can feel like you're trying to solve a Rubik's Cube in the dark. So today, we're going to turn on the lights. We'll walk through this maze together and make it all crystal clear. Ready? Let's dive in. This explainer was put together to give you a really clear, practical guide for getting a handle on these tax rules. The whole point is to swap that complexity for confidence. So, here's our game plan. We'll kick things off by understanding the deduction itself. Then, we'll get into the basic rules. After that, things get interesting. We'll tackle the complicated exceptions. I've got a great real-world example to show you how it all works, and then we'll do the actual calculations. And to wrap it all up, we'll go over the key takeaways you absolutely need to know. All right, Section 1, Understanding the Deduction. So what is this thing really? The simplest way to think about it is like this. It shrinks the amount of income the government can tax. When you claim it, you're basically saying, hey, I needed to pay for childcare so I could go to work and earn a living. So please, don't tax me on the money I had to spend just to be able to work. It directly cuts your tax bill, and that makes it a super powerful tool for families. Okay, let's get into the basic rules. The big question is, who actually gets to claim this deduction? Well, the Canada Revenue Agency, or the CRA, has a very specific rule about this, and it's the foundation for, well, everything else we're going to talk about. And here's the big one. Generally speaking, childcare expenses can only be claimed by the spouse with a lower income. You have to get this right. Think of it as the golden rule of childcare deductions. The whole idea is to make it easier for the person earning less to stay in the workforce. But this is tax law we're talking about, so of course there are exceptions. Now, you can't just claim an infinite amount of money. The government puts a cap on it, an annual limit for each child. So for any kid under 7, the max is $8,000. For kids aged 7 to 16, it drops to $5,000. And if a child is eligible for the disability tax credit, that limit bumps up to $11,000. These numbers are super important. They're one of the main limits we'll use in our calculations, so try to lock those in. Okay, next up is a term you've got to understand: earned income. Now, this might sound simple, but for childcare purposes, it has a very specific definition. It's not just your paycheck. It also includes stuff like the net income from a business you run, or even scholarships and grants. And why does this matter? Well, because your earned income is another one of those key limits that determines how much you can actually claim. It's a big piece of the puzzle. All right, now we get to where the rules can get a little complicated. Here's the scenario. What happens when the lower income spouse, the one who's supposed to make the claim, physically can't take care of the kids for some reason? Does the higher income spouse get to step in and claim the deduction? Well, the answer is sometimes. Yes, in very specific situations. So, here are those exceptions. The higher income spouse can make a claim, but only for the specific time period when the lower income spouse is, say, attending school full-time, or if they're in a hospital, or even in prison. It also applies if they have a mental or physical infirmity that's documented and prevents them from caring for the kids. Look, the best way to really get a grip on all this is to see it in action. So let's look at a real-world example. It's time to meet Thomas and Lily. So, here are the facts of the case. We've got Lily, she's the higher income earner. And Thomas, he's the lower income spouse. They've got 2 children, one is 4 and the other is 13. Now, here's the twist, the detail that changes everything. Thomas went back to school. He was a full-time university student for 8 weeks during the year, and all told their childcare costs came to $18,400. The question is, how do they claim this? Okay, time to roll up our sleeves and crunch some numbers. We're going to do a step-by-step breakdown of the calculation to figure out exactly what Lily and Thomas can each deduct. And we're going to follow a really clear 5-step process. Step 1, figure out who the lower income spouse is. That's easy. Step 2, check if the exception applies so the higher income spouse can claim. Step 3, calculate the higher income spouse's claim. Step 4, do the same for the lower income spouse. And finally, Step 5, we'll see if there are any unused amounts left over. All right, Step 1, who's the lower income spouse? This one's a slam dunk. Lily's net income is $100,000, Thomas's is $36,000. So, no question, Thomas is our lower income spouse. Okay, on to Step 2. Can Lily, the higher income spouse, make a claim? And the answer is yes, absolutely. Remember those exceptions we just talked about? Because Thomas was a full-time student for 8 weeks, that box is checked. The condition is met. And that opens the door for Lily to claim a piece of those childcare costs. Step 3. Calculating Lily's claim. Now pay close attention here, because her claim is the most restrictive one. Her deduction is going to be the lesser of 4 different amounts. That's right, 4. It's a crucial point. We have to run all 4 numbers, and then her claim is capped at whichever one is the lowest. First limitation is the easy one. It's the actual amount they paid for childcare. You can't claim more than you actually spent, right? So for them, that's $18,400. Limitation number 2 is that annual limit we talked about. Remember? We take the max for each kid. So that's $8,000 for the 4-year-old plus $5,000 for the 13-year-old. Add them up, and their total annual limit is $13,000. Okay, limitation 3. This one's based on 2/3 of Lily's earned income. And remember, that's not just her salary, it's that special definition we covered. For Lily, 2/3 of her earned income works out to $63,333. And now for the 4th and final limitation for Lily. This is the special one, the rule that only applies to the higher income spouse when there's an exception. The logic is, Lily can only claim for the specific time Thomas couldn't watch the kids. The CRA sets a weekly amount. In this case, it's $325 per week. We just multiply that by the 8 weeks Thomas was in school, and that gives us our final number, $2,600. So let's put all 4 numbers on the table. We've got $18,400, $13,000, $63,000, and $2,600. The rule is we have to pick the lowest one, and that is clearly $2,600. That's it. That's the maximum amount Lily can claim. All right, we're done with Lily. Step 4 is calculating Thomas's claim. Now, his calculation is a little different. It's the lesser of 3 amounts. But here's the kicker, and you can't forget this. Whatever we calculate, we then have to subtract what Lily already claimed. So for Thomas, let's look at his 3 limitations. The actual amount paid is still $18,400. The total annual limit for the kids is still $13,000. And 2/3 of his earned income comes out to $24,000. So looking at those 3, the lowest number is $13,000, the annual limit. But wait, we're not finished. Remember what I said? We take that lowest amount, the $13,000, and now we have to subtract the $2,600 that Lily is claiming. So $13,000 minus $2,600 gives us $10,400, and that is Thomas's maximum claim. So let's wrap this up in a final summary. They paid a total of $18,400. Lily's claim is $2,600. Thomas's claim is $10,400. When you add those up, they claimed $13,000 in total. But look at that last number. That means $5,400 of what they paid for childcare just vanishes. It can't be claimed, it doesn't carry forward, it's just lost. Okay, so after going through all of that, what are the really big ideas you need to remember? Let's boil it all down to the key tax takeaways that every family should know. First, the golden rule. The lower income spouse almost always makes the claim. Second, yes, there are exceptions, but remember how tight the rules are for the higher income spouse's calculation. Third, it is almost always a good idea for the higher income spouse to claim whatever they're allowed to. Why? Because they're in a higher tax bracket, so every dollar they deduct saves the family more money. And finally, and please remember this, unused expenses are lost forever. You don't get to carry them forward. Use them or lose them. So, that brings me to my final question for you. Are you truly maximizing your family's deductions? I know, the rules are complex, there's no doubt about it. But as we just saw, getting a handle on them can mean really significant savings on your tax bill. It is absolutely worth your time to get this right.